In the previous lessons, we learned how to read, understand, and use the profit and loss statement and balance sheet. The third financial document of your set of financial statements is the statement of cash flows, or also known as, simply, the cash flow statement. The statement of cash flow is exactly what it sounds like, a record of the flow of cash in and out of your business for a specified period of time. At first glance, it might seem confusing how this is different than the profit and loss statement that records income and expenses. However, the profit and loss statement only captures income from transactions such as sales or bank interest. Your P&L statement may even include income earned but not yet received from customers if you run your statement in accrual mode instead of cash mode. And the expenses on the P&L only capture expenses that fall under the fixed asset threshold. Remember, the purchase of expensive piece of equipment ends up as a fixed asset on your balance sheet, not an expense on your P&L. Whereas the cash flow statement captures all in and outbound cash. It includes your income from sales, just like the P&L, but it would also show cash deposited from an owner's investment or loan. On the expense side, in addition to traditional expenses also shown on the P&L, the statement of cash flow also includes money paid out for inventory and other fixed assets, as well as money an owner withdrew or money spent paying down a loan. Let's look at a sample company and its statement of cash flows. This company is Rockcastle Construction, and we are reviewing the statement of cash flows for 1 year period, from January to December of our fictitious year. At the top of the statement of cash flows, you will see the first line is always net income. This number should be the same as the bottom line number on your P&L statement if the statement covers the same period of time and the P&L was run in accrual mode. From there, you can see how QuickBooks has adjusted the net income, subtracting out accounts receivables, not yet paid by our clients, or money paid for fixed assets such as inventory. It also adds to the cash flow balance money not yet paid on bills due. If cash was spent paying down a loan shown on the balance sheet, it deducts the amount under the financing activities you can see down here. The bottom two lines give you totals. First, it shows the cash at the beginning of the period, and the very bottom line tells you cash over time for the end of the period. So the statement of cash flow is great for evaluating the change in cash over time, as well as telling you where you spent your cash during the last year. How does this information help you make decisions? Well, typically it's not a great tool for running your business on a daily basis, but it's great for comparing cash flows from year to year or over time. Let's look at an example. Let's evaluate the cash sustainability trend of Rockcastle Construction. In other words, what is their cash from a trend standpoint from quarter to quarter? Is it stable? Is it decreasing? Or is it increasing? For this scenario, I will need to rerun the cash flow statements for each quarter, starting with from January to March. So we'll change the dates from January 1st to March 31st and refresh the report. On March 31st, they had $81,172 in cash. You can see that during the first quarter of the year, they saw an increase of $9,729. Now let's run the same report for the time period of April 1st through June 30th. So we'll change the end date to June 30th and the starting date to April 1st and hit refresh. The second quarter of the year, Rockcastle Construction experienced a cash flow reduction of $4,990. If I rerun the report for July through September, so the last date is September 30th and the starting date of the report will be July 1st, and then we'll need to refresh it. You can see that their cash flow increased for the third quarter of the year, but only by $431. Now let's run the report one last time for the last quarter, ending December 31st and starting October 1st. Oops. We learned that during the last quarter of the calendar year, Rockcastle Construction experienced another cash flow reduction in the amount of $8,794. Based upon the statement of cash flows for each quarter of the year, Rockcastle Construction learned that they are experiencing an overall downward trend. This should prompt management to evaluate what is causing the loss of cash. Further investigation will be needed to see if the cause is an internal operational inefficiency, an economic trend, or perhaps the company purchased several expensive fixed assets during the year to help facilitate growth in the future, and they know they won't incur those expenses next year. Now that we've covered the profit and loss, the balance sheet, and the cash flow statement, hopefully you have a better understanding of how these three financial documents can help you guide your business.